Good morning, everyone. Mark Kavar here with a Rate Watch report. Take a look at the mortgage-backed security market, get a sense where rates are headed. Well, first of all, the fundamental news is probably the big story today. Home sales were up. They were up big, 7.4%, up I believe like 44% a year ago. Can you imagine that? That's huge. One of the concerns, of course, though, is it could be a little bit synthetic because it's a byproduct of low interest rates that that's been keeping the rates low, and also tax credit. The government policies have been working, and home sales are up. So what's going to happen when those go away? But nonetheless, they're up. GDP was also up, a little less than expected, but nonetheless up. Nonetheless, also um, with the GDP number up 2.2%. We're technically then out of the economy's growing. We're out of the recession. Still is a jobless recovery, which is really tough on a lot of folks these days. But nonetheless, we are in a growing mode, and maybe a growing mood too, but certainly a growing mode. And then this other thing that I put down here is steepening yield curve. And that's sort of an inside baseball trader kind of lingo, which is the gap between the short-term treasuries, like a two-year treasury, and the 30-year bond. It's the spread is about close to 3%. Usually it's about 2%. And we've seen this. The last time we saw this was in like the late 1990s, early 2000s, right before the economy was just ready to just go gangbusters, and that has people concerned. And so the reaction, how that gets corrected, of course, is that the longer term has to, uh, um, rates would have to go up to slow that down, that yield curve to spread that gap. So that's a concern as well for rates. From the trader's perspective, probably less concern I have about that, just considering that so much of this is synthetic in the market with the mortgage-backed security market being the bonds being bought up by the Fed and all the rest. But nonetheless, that's something that's effective on rates. So we are in this situation here with the holidays where there is a thin trading, so there's excess volatility. So I think the market has reacted probably as it usually does, a little bit overreacts. We've dropped down here as a consequence. Rates have gone up. Now I do think. Now we've switched here over to the 4.5% coupon because that's where the banks are going to be pricing at pretty soon, and we think that this par 80 is probably the range that we're going to be able to trading range we're going to get back to. So going up here is there's room to go up as a consequence, rates to go down, and this here is at the 100-day moving average line. I think that's a pretty reasonable place where we can trading range where we can go to. Here, these little green lines are support lines, but if we put our resistance line down here, we also can see that there is this trading range up here before we reach some resistance. So I think we will see that probably. I think that's the natural place to go. Who knows if it's going to be there during the holiday season, just because of the thin trading, excess volatility. The lenders, of course, aren't indicating that today. As we take a look at our lending survey, 104 lenders are reporting in. All of them are having negative pricing relative to rates. So again, I think there's room to run up here, have some price improvements, but this steady diet of news that is dictating rates going up certainly probably will carry the day here in the short term. Hope this information is helpful.